Bitcoin and gold hit all-time highs, and we are going to look at the rise of prediction markets around the world. We've got a community question about how to approach dollar cost averaging into their core portfolio, which option is best. And we are closing out with Luke Laretive back to review the portfolio of one of our community members who has submitted through Pimp My Portfolio.
Amit, I'm sorry, my friend, but this is the die with zero portfolio.
Oh.
This isn't going well, my friend. This is not going well.
Welcome to Equity Mates Investing, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. I'm excited for this one. It's a double Pimp My Portfolio in some ways. Luke Laretive is coming in, as you said, but we're also going to be reviewing a community member's portfolio. But that's not the only reason to be excited.
What's the other?
The bigger reason to be excited is we are hiring. If you are interested in joining the team here at Equity Mates, helping more and more Australians engage with their finances and making this generation the most financially literate yet, come and join the team. We're hiring for someone to join our commercial team and for someone to take up an ops role to help us get more content out, be more efficient, figure out ways to use AI, keep the trains on the tracks running on time.
Yes.
So if that sounds of interest to you, head to equitymates.com/careers. Would love to meet you.
Yes.
News and markets.
Well, Ren, it is the season of all-time highs. We've seen equities markets hit all-time highs over recent months, but gold and Bitcoin continue to hit all-time highs. Well, I should say gold continues to hit all-time highs. Okay. I feel like we're writing about it every week.
Well, let's take a step back. This year, everything's hit all-time highs. Yeah. The ASX 200 crossed 9,000 for the first time. The S&P 500 hit all-time highs. As you said, gold, every week in our daily news email, gold has hit an all-time high. 35,000 for the first time, 36, 37, 38, $4,000 per ounce for the first time. Yeah. And then, as you said, Bitcoin as well.
Yes.
The better question, what hasn't hit all-time highs?
Good question.
You know what we didn't mention? Australian property, all-time highs.
My portfolio, all-time highs.
Equity Mates listenership, all-time highs.
What hasn't? That's what we said. It's the season of all-time highs. Well, let's put some numbers to it. So gold, as you said, has surged past $4,000 an ounce for the first time. It is the most significant price increase in gold since the 1970s. It's up just over 50% for 2025.
It's a growth stock.
It's a growth stock, yeah. But digital gold has followed. Bitcoin has reached its own record high, hitting just over 125,000 USD per Bitcoin, up almost 100% for the last 12 months. Both asset classes that, people are now saying flight to safety. We're seeing a lot of fiscal strain around the world, and these asset classes are where a lot of the money is going.
Yeah, so if we just take a step back, there's another record high, government debt levels.
Yes, true.
Record high frequency of US government shutdowns.
Yeah, yes.
Record high trade tensions. And this one's a bit grim, but record high conflicts around the world. Yeah. Well, that might not actually be a record high, but there are a lot of reasons to be concerned at the moment. And so gold is always seen as a safe haven asset, and it is acting like a safe haven asset. What is unusual is how fast it is growing. And so, I think people who have had some, that 5% allocation to gold in their portfolio are pretty happy right now.
It'll be 10% now.
Yeah.
One to watch. I don't have any in my portfolio, kicking myself because of it.
Yeah, I dollar cost average into Bitcoin, but
true. But
it is. As I've been watching this, I'm like, I should have an allocation to gold, but you don't want to chase what's already happened. Yeah.
Anyway, I teed it up at the top. We're going to unpack the rise of prediction markets around the world, something that we've also been watching.
And I'm going to close out with a business idea around prediction markets. So first of all, for people who are unfamiliar, the prediction markets are really characterized by two big names. This is an American story at the moment.
What are prediction markets?
I'm going to get there. Cool. Yeah. So the two are Polymarket and Kalshi.
Yeah.
And they're kind of like a hybrid of a stock exchange and a sports bet account. And they allow you to make predictions on the outcome of future events. And then as the probabilities of those events change over time, you can essentially trade that trend. It's not like a binary outcome like with stocks where you're right or you're wrong, but you can, you can buy something when it's a 10% chance of it happening and sell it when it's a 40% chance of it happening and make money. So to give you a live example, if I just go on Kalshi now and look at the top market, the market is what will Trump say during the round table on Antifa?
Okay.
And then there's a market for will he say the word Biden? There's a 99% probability
She
yes.
says it all the time.
So you could take the no side of that bet and say that he won't say the word Biden.
And then as the speech is occurring, that should change in real time. Yeah.
And so in theory, because there's a 99% chance of it happening, the way it works is like all the odds are 0 to 1.
Yeah.
So you could put a 1 cent bet on and get $1 back.
Yeah. Okay.
Pretty good odds. So that's the prediction markets. Now, they have taken off. And the reason that I wanted to talk about them is because they are going mainstream in the US. The parent company of the New York Stock Exchange, Intercontinental Exchange, has just put $2 billion investment into Polymarket. Polymarket are the second biggest in the market at an $8 billion pre-money valuation. So Polymarket do about $700 million in volume a month.
Wow.
And Kalshi do 1.3 billion.
Wow.
Those numbers are from investing.com. So together they're doing $2 billion a month in predictions.
For a country that not so long ago had gambling was illegal.
I know.
This is wild.
Yeah. And it is gambling. Like let me just read who will win the next presidential election, New York City mayor race, will Taylor Swift occupy all top 12 spots in the Billboard charts, how many album sales will Taylor Swift have? This is just all from the front page that I'm looking at. Who will be arrested before 2027? How high will Bitcoin get this year? Who will win the Nobel Peace Prize?
This is ridiculous.
It's very American, I've got to say.
Yeah.
But who will win Dancing with the Stars season 34? This is Australian. Robert Irwin, 42% chance.
Oh, I've seen a lot of him lately for some reason. Yeah.
Well, if you want to bet on it, you can. So those are these markets. Now, they are not allowed in Australia at the moment.
Thankfully.
But I said I wanted to close. Well, I think like this is a watch. I think be aware of it. There are a lot of people making a lot of money in this space. One trading strategy that I've seen is people just take the no on outrageous things.
Yeah.
It's like, there's a market, will Russia fire a nuke in 2025? And people just take the no on that.
Yeah.
And yeah.
Wow.
Oh, that's a morbid example, but there's
It's
people
not
have made.
is it?
It's not. No.
Yet.
But I want to suggest that when it comes to Australia, I have a business idea, and I want to flag it here.
Okay.
Because it will happen. If these markets get allowed in Australia, this will happen. An Australian property prediction market. So here it is.
It's only going to go one way.
Here it is. So REA and Domain have their price guides, but then they build a prediction market adjacent to it, and they allow you to bet on houses and whether it will go above or below the price guide.
Who in their right mind would ever bet below?
But the odds will be set by that. Imagine Australia's national pastime, speculating on property, open to all of those who can't afford to speculate on property.
Imagine in an unregulated market, the property market, what that will do, the price fixing that will go on if you know that you've got this huge bet on the other side.
Well, this is a criticism of these prediction markets, which is there is no regulations around insider trading. So there was unconfirmed reports that people found Barron Trump's Kalshi account.
I was going to say, all he has to do is look at this and say, okay, Dad, don't say Biden, and I'm going to put a shitload of money on this.
Yeah. But look, those reports were unconfirmed. But yeah, look, there is a known criticism that people can trade on inside information here. It's like, it's not regulated like it is the stock market.
Wild.
Yeah. Again, good reason why it's not allowed in Australia. But Australian residential property prediction market. I'm telling you, it would go off.
We don't want that. We don't want that.
And then imagine REA's slogan: "Build your deposit faster by betting on."
Oh, goodness me. Well, I hope that doesn't happen. Anyway, to keep up with more of these, I guess, substantial news headlines from around the world, sign up to our daily newsletter. We'll send you a dot point summary of all of the important headlines that are making news, I should say, around the world. Link in the show notes or description below.
Let's ask the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, friend. I've got a question.
Answered.
We love hearing community questions come in, and we really appreciate if you can leave us a voice note. Head to equitymates.com/contact. Today's has come in from Janita, though. She didn't leave us a voice message, but Ren, she says, I invest $700 a month into DHHF, monthly $400 into VAE, and $400 into VEQ. Is this a good core portfolio, or is there too much overlap? If I should change my core, what other core ETFs can I choose from? And also my satellite, I do 275 into NDQ and 225 into HAC. NDQ overlaps with DHHF. If I should change my satellite, what other ETFs should I consider? Now, of course, very personal here. We don't know your situation, but we can answer this generally.
Yeah. So just generally, can I start by saying, doing that maths quickly as you were talking, $2,000 a month invested.
Solid.
Like, well done.
Yeah, big time. Big time.
If you can consistently do that for months and for years, you're going to be in a very good position.
Yeah.
The fact that you're investing in a core and satellite approach into predominantly index ETFs, also just well done. There's a lot to like here.
Yeah.
Let's start with the core, and then let's go to the satellite. So you mentioned 3 ETFs with ticker codes. So maybe let's step through them and explain what they actually are.
So the first is DHHF. It's the BetaShares Diversified All Growth Fund. This is an ETF of underlying funds, or it's a predefined ETF. 37% goes into Australian markets, 41% goes into the US markets, 16% goes into developed, and then 6% goes into emerging markets. So you're putting $700, it's split globally, and that makes up the first ETF. The second is VAE, which is Vanguard Asia ex Japan. 1,400 companies across 12 markets across Asia, excluding Japan. And then VEQ is Vanguard International Equities ex-US. So it's really European markets. You've got UK 23.5%, France 15%, Germany about 15%, Switzerland 14%, and Netherlands 6.2%. So across all 3 ETFs here, you are getting global exposure. You've got covering all major markets and emerging as well. So that's the current setup.
Yeah. Let's start with the core. There's a lot to like here. I want to start there. Janita, I think you've built a good core portfolio. So to start, you've built it around DHHF, which is predominantly Australia and the US, but it is an all-in-one ETF.
Yeah.
But because it's predominantly Australia and the US, 37% Australia, 41% in the US, you've then complemented it with Asia and Europe to up that exposure.
Yeah.
I think the logic is sound. It's a strong core portfolio. It's low cost. It's globally diversified. It's all index based. You're going to get the winners wherever they come in those markets. So like a lot to like. The one thing I would tweak though is just to think about the weightings to the different parts of the world. So $400 in Europe, $400 in Asia, $700 in DHHF. If you do the maths, that works out to be $259 in Australia and $287 in the US. If you think about how that $700 in DHHF is split.
Yeah.
So really you're investing a fair bit more in Asia and Europe over Australia and the US.
Yeah.
So my tweak would be maybe change that 400 to maybe like 300 or 200 in those other 2 ETFs and upweight DHHF.
Yeah.
But like that's a minor change.
Minor tweak. Particularly, DHHF does have exposure to Europe and Asia. So I would agree. Tweak the investments per month.
So just do the maths and I would try and say across Australia, US, Asia, Europe, try and be sort of equal weight across those. Yeah.
So look, I think though, for those that have just joined the show, you could have 2 options here. If you wanted to just go DHHF or an equivalent VDHG from Vanguard, they are your all-in-one ETF. So there's nothing wrong with taking that approach. Or you could do what we're doing and get rid of DHHF and have a little bit more control of your weightings and choose core index ETFs to build your own core as well.
Yeah, you could do what Janita's doing.
Or you could do, you could do what Janita's done.
So that's the core. Great work. Keep going. Keep dollar cost averaging. You're doing a great job. Satellite. 2 ETFs here, Hack and NDQ.
My thinking is, look, NDQ for me is probably a little bit overkill to have as a thematic because you're going to get primarily the same top 10 or 15 in DHHF. So a lot of people would use NDQ as part of their core. It's just giving you, effectively tech, US tech. But I don't think there's anything wrong with having thematic ETFs as part of your satellite and not overdoing it. I think Hack has been a great performer. But this part of the portfolio, Ren, I think is very personal. Like for us to say these are the best, you can't say these are the best satellite thematic ETFs because it's really down to what you're trying to achieve and beat the market.
Yeah.
I'd have a few ideas offline, but
we've certainly spoken about ideas before. But yeah, look, I have Hack. I've had it for a long time. It's been great for me. There's plenty of thematic ETFs that could complement it. I think you're right that it's like if you've got this US exposure in your core and then you've got NDQ, that obviously overlaps, but then Hack obviously overlaps as well. So just think about like how much exposure you want to US tech. But I don't begrudge anyone wanting to ride the US tech wave at the moment. Just be mindful that things go down as well as up.
Absolutely. Well, Janita, thank you so much for the question. If you'd like to submit one, head to equitymates.com/contact. Leave us a voice message. We'd love to get it on the show. We're going to take a quick break, and on the other side, we have Luke Laretive coming in to review the portfolio of one of our community members who have submitted it for Pimp My Portfolio. We'll be right back.
This is Pimp My Portfolio. Pimp My Portfolio.
This is a segment where we get a community member to submit their portfolio for one of our experts to review to provide some ideas on how to improve it. And today we have none other than Luke Laretive in the studio. Luke, how are you?
Brycey, Rand, let's roll.
Let's do it. And on the line we have community member Amit. Amit, how are you going?
I'm good, Bryce. Thank you. Thanks for having me.
No worries. All right, Ren, we'll take us through it. What's in Amit's portfolio?
So Amit has a portfolio that we haven't seen before in Pimp My Portfolio. He's got CFDs. So I'm excited to see what Luke thinks about that. But just to give an overview, I guess a number of the holdings, they have some shares and some CFD positions. But to just talk through the positions, we've got 4DS, Appen, Data3, Drone Shield, EML Payments, Electro-Optic Systems, E-Road, GQG Partners, Megaport, PYC Therapeutics, Web Travel Group, WiseTech Global, and Zip. So I would say 13 stocks, largely in that Aussie smalls space. Luckily, we've got an Australian fund manager, or calls himself a financial advisor, but has one of the best performing small cap funds.
Yes.
So probably no better person to review this portfolio. So Luke, we always like to start with...
I forgot the bit that I'm a bad bloke, so that's
well, we keep that off mic. So Luke, we always like to start with a name or a nickname to characterize the portfolio. So where do you want to start today?
I mean, I'm sorry, my friend, but this is the die with zero portfolio.
This
isn't going well, my friend. This is not going well.
Starting strong.
Wow. All right. So, Amit, before we let Luke loose, tell us a bit about the portfolio, how it came to be.
So I've been into the market short to long term. I've been into stocks like 6 or 7 years. And it's good fun. I love doing research about the companies and following them on LinkedIn and wherever, listen to their podcast or meetings, etc. So I'm kind of enjoying it, and it's kind of working out for me so far. But let's see. I understand that it's a bit risky, and it's something, the money, I'm okay to kind of lose this money is where I'm coming from. That's my risk appetite.
That is a red rag to a bull saying you're willing to lose money to Luke Laretive. So Luke, where do you want to start with this portfolio?
Yeah, I mean, I don't like a habit of making losing money. So, we want to try and avoid that if possible. I think, look, there's too much here to go into. I think let's start with the good and the positive. So there are some decent stocks in here. WiseTech looks cheap at the moment, kind of like that. Data3 is not a bad business. I don't own it, but not a bad business. Web Travel's like you could do worse. Not a bad business. Zip, yep, maybe it's okay. Pretty expensive, but okay. Understand why you might own it. GQG's going through a troubling time, I suppose, or not having the best run at the moment, but it's okay, and at least you get paid a nice dividend to hold that stock kind of in the interim. So that's kind of where we're at. 40S is a dog. Echo IQ is a dog. Appen's a dog. EML Payments is a dog. PYC is a dog. Like they're dogs, right? So not really that interested in owning those. EOS and Drone Shield at this point, in my mind, are like meme stocks. So I think this defense thing's going to end in tears, but we'll see. So yeah, that's kind of my overall assessment. I think the weights here are all massively skew-if as well. If you're going to run direct stocks, I think like 15 is the bare minimum, and I want like at least 5 sectors or 5, I want 5 or 6 different styles of idea in there, not everything in tech or everything in high. I mean, this is like the highest beta portfolio I could probably build if I dreamt one up. So, I'd like to see a little bit more diversification, not just in more names, but more different types of ideas with different drivers. Think about it, max 10% in an individual stock as a start position, minimum 1%. Your kind of average position might be 3 or 4 or 5%, depending on how much concentration you're running. That's how we do it. That's how I think most good fund managers do it across sort of all markets, to be honest. If you're an active manager, I'm sure I always talk about Nick from Fairlight, but I suppose just because I like him. But, Nick would run a similar setup. It's not, this isn't unusual or, particularly novel. You can go real high concentration and maybe you might be running 15s, 10s and 5s. But that's sort of where I'd like to see the weights. And, ideally you want to weight it by expected return. You want to have, more money in the best ideas, most highest conviction positions, and less maybe in stuff that's got maybe a smaller margin of safety or the valve's not quite where you want it to be yet.
Nice. So let's start on the CFD side of things. And Luke, obviously would love to get your opinion, but why have you used CFDs, contracts for difference, for those that have just joined the show, as part of the portfolio?
No, that's a great question. So what I've been doing is I kind of want to have some leveraged. So previously, most of my savings were leveraged for the stock market. So what I did is I took out 60% of the cash and put it to my homes and other accounts. But I still want to have that opportunity where I can have more leverage. I understand there are more risk with it. So now previously, let's say if I were playing with $10, now I'm playing with $4. So $6, I took it out. So it's my style of mitigating the risk.
Okay. Fair call. Luke, what are your general thoughts on leverage in stock portfolios?
And through CFDs particularly,
Yeah, I think, look, derivatives are tricky, right? So I think I'm probably the only level 2 qualified derivatives advisor you guys talk to. So we don't ask everyone that comes in the door. But I think that the people that I know.
Show us your certs.
You guys should be validating these.
Yeah, well, Bryce is level 3, so what do you do about it?
No, but I think there's only 2. But there's only 2. But I think so it is an area that I know something about. I wouldn't recommend CFDs as a general comment. I think that there are better, cheaper ways to get leverage. I think you have to use something like a margin loan or a CFD to be able to gain exposure to these sort of smaller companies. But, it is an expensive way to do it. The spreads, can be problematic. And it is sort of getting more towards gambling on stock codes and a bit less about investing, probably in the traditional kind of equity mate sense of the word. Don't have a problem with it. It's not like I have a problem with it. I think there's just better ways to do it. And I'd like to see it done maybe with gearing's okay, but you need to be understanding, what you're owning gearing. There's probably enough leverage in the stocks that you've picked here, Amit, that you don't need to be gearing them up. If you're looking for better returns, like I know what you do with your stuff, Bryce, where you're kind of gearing up an index portfolio. It's like, well, you're buying 5,000 companies or whatever. So it's, you're not really, I suppose, taking much idiosyncratic risk, and you don't have a lot of capital destruction risk there. Yeah. I think here, could Drone Shield go to zero? Yes, it can go to zero.
Sorry to interrupt there, Brian. So I'm going short on Drone Shield at the moment.
Oh, okay. Well, that's almost even more deadly. But
that must have hurt recently, Amit.
No, I've been open short position only last couple of days.
Okay.
Look, I think anyone who shorts stocks will tell you shorting stocks on valuations is a quick way to go broke. Right, so you don't want to short on valuations. You want to short for catalysts. So I'd be really, really careful of that. As much as I'm super bearish on Drone Shield, and I don't think it's going to. I think it's way overvalued. I think it can stay overvalued longer than you can stay solvent. So that would be my massive asterisk caveat there. But yeah, look. Anyway, I didn't know it was short, so it's hard.
First short we've had on Pimp My Portfolio. Right?
Yeah,
I think so.
Oh, cool.
So I guess, Luke, just to round this out, obviously this is, I guess, like a different portfolio construction than we're used to seeing here, and then perhaps you would run.
Yeah.
But the point of this segment is whatever portfolio comes across your desk, we want to give some suggestions for improvements. So to wrap it up, if you were to think about some ways to improve Amit's portfolio, where would you start?
I would get to a portfolio that sort of, like I said, starts at maybe 15 or 10% as your biggest position and kind of, drifts down to maybe 2% as your smallest position, 1 or 2% as your smallest position, and has, 20 ideas in it, 30 ideas in it, something like that are more diversified across sectors. If you're going to stick to just to the ASX, across the ASX, and then think about applying leverage, one, where you can get it, and two, more evenly, I suppose, is probably, more consistently across your ideas, because even us, we're only going to have a win rate of 50 or 60% if we're really good. So you got to understand that if you're not going to win, you don't know where you're going to win necessarily. So you really need to, not be so high conviction on certain things. And then I think also the quality of the businesses you're buying. I don't mind buying specky stuff, but it needs to be, the right specky stuff and at the right weight in your portfolio. And so I think building something out that's a little bit more built around earnings and predictable things that you can back in, rather than kind of hype around defence or, drug trials or, success at FDA, or, big turnarounds like even Megaport, which has been good. We've made money out of it. I mean, we've sold it, right? So I think that, just be careful, because they are more higher risk, higher return type opportunities.
Love it. Well, Amit, plenty to think about. As we said, there's always firsts here at Equity Mates. First time we've seen CFDs, first time we've seen a short, but you're obviously high conviction, so we can't.
First time we've seen a level two options advisor.
Yes. But Amit, thank you so much for submitting. We hope you got something out of that with Luke today.
Great, thank you. Thanks, guys. That's awesome.
Man. Well done.
Thanks, Amit.
If you'd like to submit to Pimp My Portfolio and have Luke cast his eyes across it, head to equitymates.com/contact, and there's a form there to fill out. But Ren, that does it for today. We'll pick it up next week.
Sounds good.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.